high. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the story behind the major developments in the banking sector. It is 3rd of August and I am Ruchika Chitravanshi. We will start the show by talking about the rising attrition in the banking industry in our cover story today. We will be joined by Mswipe CEO Ketan Patel for our Banker's View segment. In Banking for You, we will tell you all about non-banking financial companies or NBFCs. Our consulting editor Tamal Bandyopadhyay will give us his expert take on P2P lending, the upcoming monetary policy and more. At the end of the show, we will tell you the results of the last week's poll and the question for this week. Attrition has become a major challenge for private sector banks. From poaching to competition from fintechs, there are a whole lot of reasons why retaining employees is turning out to be more difficult now than before. In our cover story today, Manojit Saha digs deeper into the private sector bank's struggles with the high attrition at the front lines.
HDFC Bank, the country's largest private sector bank, which has 180,000 employees after adding 29,000 in the last year, has experienced an attrition level of over 30%. More concerning is the entry level, where the attrition ranges from 40 to 50%. The HDFC Bank has 13 levels under the Chief Executive Officer. The attrition rate is between 20 and 30% for the 4 levels just above the entry level, and in the top half, the rate is in the single digits. Is HDFC Bank an isolated example? Hardly. Look at Axis Bank, which has close to 92,000 employees. Among its sales teams and branches, which are the front lines, Axis Bank has an attrition level of 33 to 35%. The bank's MD and CEO, Amitabh Chaudhry, emphasizes that the overall attrition rate of the bank has remained in the same zone for quite some time. All the institutions, at least the ones we compete with, are used to this kind of attrition rate, and they have been operating quite well through that period without seeing a large jump in staff cost because the attrition rates are high. Another private sector lender, Yes Bank, is experiencing an attrition rate of 43%, which is again mainly contributed by the frontline staff. Yes Bank MD and CEO Prashant Kumar said the bank is working towards reducing the overall rate to 25 to 30%. Banks are experiencing this high attrition rate amid a sharp rise in credit offtake, particularly retail loans like home and auto loans. According to the latest RBI data, non-food credit growth was 16.3% year-on-year in June, while retail loans grew at a faster pace, 20.9%, driven by housing and vehicle loans. Churning at the front lines also comes when many banks are expanding their branches rapidly. HDFC Bank has added 1,482 branches in the last 12 months alone and expects the same momentum to continue for the next few years. So why is frontline attrition in private banks so high?
So there is a very high pursuit of growth amongst the private bank, especially in the retail lending space. And that's kind of widening the demand supply gap. Average operating plans, for all these private banks indicate that there would be a 13 to 14% increase in the manpower projection. So a lot of private banks are now diversifying in the retail lending space, and that adds on to the demands to an already widened gap. Most recruitment demand is coming from tier 1 and metro cities, and there the average salaries paid to these individuals is around 20 to 25,000 including incentives, and that's the average. And that makes them a very easy prey for other banks and NBFCs to poach them with a 10, 15, 20% hike. With a focus on speedy hiring and deployment, a lot of banks are compromising on the induction and training part, which has a direct impact on the productivity, and that pressure leads to attrition.
The high attrition rate among frontline staff can lead to disruption of customer services. Against this backdrop, What can the banks do to fix it?
We feel that new hire induction and product trainings is extremely important, because that helps a new hire settle down into the ecosystem of the banks and NBFCs well. What we are witnessing now, and it's a recent trend, is a lot of private banks and NBFCs are actually fast tracking the growth of high performers by either absorbing them from a temporary role to a permanent role, or promoting them to a supervisor level. This helps, individuals who are in that position, get a feel that, this could be a future career option for them, and they can grow to a higher supervisory level. Finally, while the money can never be a permanent fix, but we also, strongly advise our, clients that, annual salary hikes, a constructive annual salary hikes, especially for the frontline sales force, creates a sense of stickiness amongst them, because then they feel that, they are part of the growth.
M.K. Jain, who retired as RBI Deputy Governor in June this year, had said in a speech in May that attrition and high employee turnover lead to loss of institutional knowledge, disruption in services, and increased recruitment costs. As such, private banks would do well to bring attrition under control before it imposes further costs on them.
Frontline staff makes up a big chunk of the banking workforce, and as Manojit said, a high attrition rate among them can disrupt customer services. Moving on. In an exclusive interview with Business Standard's Raghu Mohan, Ketan Patel, CEO Mswipe, shares the direction in which the point-of-sale business model is evolving and the need for multiple revenue streams to be a leader.
Welcome to the BS Banking Show, Ketan. Good to have you here. How do you see the point-of-sale business model evolving from here on?
So, Raghu, thank you for inviting me. The POS business has been growing at a 4-5% rate on an annual basis. I think it will continue to grow at the same pace for the next 3-4 years. So, there is a lot of churn happening in the industry. Merchants are moving from one service provider to the other, but the new merchant addition is not more than 4-5% on an annualized basis.
What are the specific issues you face in onboarding merchants?
So Raghu, there are two issues, right? Now with QR coming in and with no MDR happening and no rental happening, right? You just put the QR sticker and you are able to accept payments without paying anything. And there is no MDR. There is a transaction of 100 rupees, you get 100 next day morning into your account. So these two are issues which POS acquirers are facing. On a terminal, since there is a capital cost involved, the acquirer will have to charge rental to the merchant, which the merchant doesn't want to pay. And the second is MDR. Since POS is a card-led model and there is MDR on that, the merchant now is used to not paying MDR, right? And these are the two issues why we feel that the POS is not growing as much as it should grow, like the QR business.
So if MDR as a source of revenue is off the table, almost off the table, how do you diversify your income streams?
So Raghu, if MDR is off, then you have to use QR as a way to acquire a merchant and then cross-sell and upsell. So you'll end up like most of the players today are lending, selling insurance, doing inventory management, billing. These are the multiple ways of getting revenue from the merchant by acquiring him cheap. Acquiring a POS merchant will cost you between 3,000 and 4,000 for every merchant acquired. But a QR merchant can be acquired for 250 to 300 rupees. So, cross-sell is where you will make revenue, and the other is upsell, right? If you see a lot of transactions happening, you will be able to give a cheaper POS device to the merchant so that he can accept card payments also. So these are the only two areas where you can make revenue if you acquire a QR merchant.
When it comes to Mswipe, what are your initiatives on these fronts?
So on the POS side, what we've done, Raghu, is we've tied up with banks. Banks have a captive base. We don't want to acquire on our own. So we were earlier acquirer on our own, where we used to go and compete with banks. Currently, we've changed our model as far as POS is concerned. We want to partner with the banks because we have the platform, we have the inventory, and we have the tech to support the banks. The banks are good in, so my pitch to the banks have been that, you want current accounts, you are not good in payments. I am good in payments and I have nothing to do with current accounts. Can we partner together where I can help you increase your current accounts? That has worked well. As we speak, we've tied up with 20 odd banks.
The question is that when you say lending, other banks also can give loans. So what is the USP of your lending vis-a-vis other lenders?
See, Raghu, one, I will not lend to a bank merchant, but just to tell you, banks also don't want to lend to these merchants. Banks don't want to do unsecured loans to these merchants. They want to do secured loans. Whereas most of these small merchants are in need of unsecured short-term loans, which the banks don't want to do. So there is play for both. A couple of banks where they've allowed us to lend to their merchants. What we are doing is we are ensuring that we keep the banks updated on how the loans are going, so that if there is a larger loan required, the bank knows whether it wants to lend to the customer or not, right? It's not new to credit or a subprime customer when it comes to them.
Do you see this business evolving into an inventory management tool?
This business, no, not inventory management. There is no money to be made in a inventory management business. But this business will evolve in whoever the company which will do well is the company where the entire ecosystem is covered, where there are multiple revenue streams. You are not dependent. You are not a one-trick pony. You're not dependent on one single revenue stream. If you have multiple revenue streams with the merchant and you are completely into his ecosystem, right? If you're able to provide inventory, billing, other services that he wants, tax, plus a POS or a sound box, then you're sorted.
How do you see the larger issue of UPI pricing in all of this?
I don't think the government, this is my personal view, I don't think the government is going to charge on UPI debit at least. If it happens, then there will be a huge uproar and cry, right? I don't think it is going to happen. Credit, too early at this point in time, but at least what I'm seeing is more than 2,000. The transactions are less, and plus a lot of merchants are not accepting RuPay credit cards at this point in time. I'll just give you my personal example. I was in Apollo Spectra Hospital with someone, and I was making a payment through Paytm where my RuPay credit card is linked. They declined the payment. So I'm sure this will be happening with a lot of merchants. And this was a transaction which was less than 2,000. It was $1,300, but it was rejected. So currently, from a merchant, if I think from the merchant's point of view, he doesn't know whether the transaction is going to be less than 2,000 or more than 2,000. He doesn't want to accept credit cards at this point in time because he's so used to not paying MDR. To pay MDR is going to be a huge change, and that will take time. It is not going to happen in a jiffy.
Now, the issue is that the whole idea of UPI, RuPay credit cards was to widen acceptance. If merchants are going to resist, what happens to the whole concept itself?
If you think from the merchant's point of view, he can't keep resisting, right? If he loses sale, I had an option of using my debit card, but if I would have walked away, and a couple of customers like me would have walked away, the merchant would start accepting RuPay credit cards, and he'll price it accordingly, right? Currently, the service that was offered to me for 1,300, he'll charge 1,350 for it. But ultimately, it is the customer who's going to bear it.
Do you think that the entire idea of UPI pricing should be linked to the turnover of the establishment?
Theoretically, yes, Raghu, but very difficult to do it, right? Most of the shops also have multiple entities within that shop to ensure that they don't cross the threshold of 20 lakhs. So they have multiple proprietorships and partnerships within that. So it's very difficult. At this point in time, I don't think the country is ready for that.
You mean to say it's very hard to slice and dice merchant establishments based on turnover?
Right. That's right. Larger GST ones you can do, but of the 40 odd million merchants, 28 to 29 million are below the GST threshold. How will you slice and dice them?
Ketan, it was good to have you on the BS Banking Show. We look forward to having you again. Have a good day.
Thank you, Raghu. Thank you so much. Thank you. Bye. Appreciate that. Bye.
That was Mswipe's Ketan Patel on turning QR challenges into an opportunity. Non-banking financial companies, or NBFCs, play a vital role in the financial landscape of the country. From lending to insurance, they cater to diverse needs in the economy. So what exactly are NBFCs and how do they contribute? Ayush Mishra delves deeper into this world of finance.
world's largest asset manager, BlackRock, has joined forces with Mukesh Ambani-led Jio Financial Services to foray into India's asset management space. The move will provide Jio Financial a good foundation for its financial services ambitions. Jio Financial Services recently hived off from Reliance Industries and emerged as the country's third biggest non-banking financial company, or NBFC. But what are NBFCs? A non-banking financial company is a company that does not possess a banking license but offers different types of banking financial services. It provides specific banking services and generally refrains from accepting demand deposits from the public. NBFC is a company that is registered under the Companies Act 1956 and is involved in the lending business, hire purchase, leasing, insurance business, receiving deposits in some cases, chit businesses, stocks and shares acquisitions, etc. According to Indian Brand Equity Foundation, asset under management or AUM of NBFCs has increased from $44.02 billion in March 2008 to almost $330.21 billion in March 2022. The AUM is expected to increase further, indicating the importance of the sector to overall credit delivery in the economy. Non-banking financial companies can be either deposit accepting or non-deposit accepting ones. If they are non-deposit accepting NBFCs, ND is suffixed to their name, as in NBFC, ND. The non-deposit accepting systematically important NBFCs are known as NBFC, NDSI. But how are NBFCs different from banks? Bank is a government-authorized entity that provides banking services to the people. An NBFC is a company that offers similar services without a banking license. NBFCs had a humble beginning in India in the 1960s as an alternative for people whose financial needs were not met by the existing banking system. But the sector flourished in the 1990s and early 2000s, triggered by economic liberalization, regulatory changes, and rising demand for specialized financial services. Bajaj Finserv, Aditya Birla Capital, and the new Jio Financial Services are some of the leading non-banking financial companies in India, offering diverse financial services across lending, insurance, wealth management, and more. NBFCs have been playing a significant role in financial intermediation by complementing and competing with banks, thereby bringing efficiency and diversity into the financial ecosystem. NBFCs enjoy greater operational flexibility in taking up a wider scale of activities, entering new geographies and sectors, and thus growing their operations.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
While we learned all about NBFCs, it is also interesting how the latest entrant in this space, Jio Financial Services, can disrupt the sector. It is now the third biggest player in the NBFC market. Time now for our expert take. This week, I spoke to our consulting editor, Tamal Bandyopadhyay, on issues ranging from P2P lending, rising attrition, and the monetary policy. Hi, Tamal. Welcome to the Business Standard Banking Show. In your Bankers Trust column that you've written this week, you've talked about that RBI should come down on the practice of renting out the P2P license or the peer-to-peer license before it is too late. What are the concerns that you have and why?
It's not P2P financing. It's not P2P financing at all. It's something else. It's they're creating a pool of funds, and from that pool of funds, they are giving money. And I understand that even if money, some borrowers turn defaulters, it doesn't really, it's not affecting the lenders at this point of time, because the fresh inflow in terms of new lenders coming in, their money is used to pay back the old lenders, so on and so forth. And one of the ways it's doing it is this, the platforms, the P2P platforms are renting out their platform to other non-banking finance companies who have nothing to do in the name of outsourcing. But Reserve Bank of India norm does not allow this kind of outsourcing. So what's happening is, kind of, I would say it's a time bomb ticking away the asset liability mismatch we are allowing it to create. And we'll get into big trouble. So which is why I said to Reserve Bank of India, it's high time. I think it's tolerating enough. I think it should come down heavily. And this practice must be checked. I mean, you can't get away doing this. What is happening in India is not P2P, what a P2P marketplace is expected to do. P2P marketplace is a connecting link between a borrower and a lender. You can't have multiple borrowers taking money from them, create a pool of money, and from that pool you lend, and you make sure that borrower gets good interest rate. How can you have a fixed interest rate when it depends on the profile of the lenders? Who are you lending to? So P2P platform is not expected to run its own balance sheet and manage a pool of funds. They are not fund managers.
The other thing, Tamal, that has been discussed in this show also before, but there have been so many reports, is around the attrition in private sector banks. What is happening there? Has the attrition gone up, and what is the reason behind it?
Because, the environment is changing. There are so many opportunities. It's not necessarily a banker is leaving to join another bank. There are many other entities, the fintechs and tech fins and various marketing organizations. A lot of other entities, they are wing the bankers. Because while the banks are turning into technology companies, the other fintech and tech fins and various other organizations, they are looking for bankers, particularly at the mid and junior level, for their job. And if not anything else, there are people also leaving to start startups, which has never happened before. So it's a very difficult, very different time. The environment, the ecosystem, and the psychology of employees are changing. So it is the biggest challenge. I think there was a time when it used to happen that people are leaving and you offer he or she, him or her, more money to retain her. But now we are seeing a situation where money cannot retain. I think they are looking for this generation, looking for challenges.
We have time for one more question, and we cannot let you go without talking about your thoughts on the upcoming monetary policy. What are you expecting the RBI to do?
Both US Federal Reserve and ECB, they have hiked their rates, 25 pips each. ECB has given a sense probably the next meeting can be sort of status quo, but there is no guarantee as such as far as the US Federal Reserve is concerned. Now, what's going to happen in India? I think Governor once said that it's a no-brainer. This is going to happen. So I would say it's like a no-brainer. It's a status quo, which means that the repo rate will be retained at 6.5, and even the stance of the policy, which is withdrawal of accommodation, also will remain. Absolutely, there is no change. Why is this? Till the last policy, we are pretty optimistic, pretty bullish. Of course, one part of the resilience and the strength of the financial system, financial sector stability, that continues to be, but the inflation front, what progress we made, I'm blaming on tomatoes, particularly the food inflation. Is pretty bad. May inflation was 4.25, which was to 25-month low. I'm talking about CPI inflation. And June, it went up to 4.81. As we speak, everybody and his aunt expecting July inflation to be more than 6%. And I think the rate cut, which was expected probably in the last quarter of this current financial year, probably delayed. It can spill over to the next financial earlier. Similarly, the change in the stance also probably it will get delayed. So for the time being, it's status quo and a long pause. We have to wait for the stance to change and wait even longer for the first rate cut.
Well, Tamal, it's just a week away, so we are going to find out very soon. But yes, status quo on the policy seems to be the word on the street as well. Let's see what happens, and thank you so much for sharing your thoughts on all the other subjects today. We look forward to meeting you again next week. Tamal's take on the monetary policy is of status quo. This was, in fact, our poll question last week as well. Let us find out what the Business Standard viewers thought of this. Here's what we asked you last week. Will the RBI keep interest rates unchanged? 71% of our viewers said yes, it would keep the interest rates unchanged, and 29% felt no, it would not. Before the next week's poll question, a bit of background. The Mahindra Group made news recently for acquiring 3.53% stake in the RBL Bank. It also indicated that it may increase its stake up to 9.9% in future, which is just below the 10% mark currently permitted according to the RBI rules. The RBI has been against the entry of business houses in banking due to conflict of interest. So here's what we're asking you this week. Should corporate groups be allowed to enter banking? Our poll opens today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.